In just 18 minutes on live TV, Nixon killed the gold standard. Overnight, every dollar became something new, backed only by trust, not gold. This wasn't just an American decision, it was a global rupture. Fixed exchange rates collapsed, inflation surged, and money itself was reborn. The dollar and global finance would never be the same. It was Sunday night, August 15, 1971. Millions of Americans turned in as President Richard Nixon delivered a live televised address. His tone was steady, but what he said would shake the foundation of the global financial system. Nixon declared that the United States would no longer allow foreign central banks to convert U.S. dollars into gold.
Into gold or other reserve assets.
The gold window was officially closed. This was more than a policy breach, it was a break from a promise. Since World War II, the world had operated on a system where the US dollar was backed by gold. Foreign governments could exchange their dollars for gold at a fixed rate. Now, that anchor was gone. Overnight, money had changed. But Nixon didn't stop with just one announcement. In the same address, he introduced two more sweeping measures. The first was a 90-day wage and price freeze across the entire U.S. economy. He claimed this would combat inflation, stabilize the market, and protect the average American. The second was a bold 10% import surcharge on all dutiable goods. This meant foreign products were now more expensive to import. Nixon said it was necessary to defend American jobs and pressure other nations to adjust their currencies. To the public, it seemed like a strong and sudden defense of the U.S. economy. Behind the scenes, there was panic. America's gold reserves had become dangerously low. Foreign central banks were holding more dollars than the U.S. had gold to cover. And some didn't just threaten, they acted. In 1965, French President Charles de Gaulle sent a naval vessel to New York Harbor to physically retrieve France's gold reserves. Other countries lined up behind him. It was a humiliating sign that confidence in the dollar was slipping away. Every shipment of gold was more than metal leaving American vaults. It was global trust draining out with it. What had once been seen as rock solid suddenly looked vulnerable, and the fault lines in Bretton Woods were now visible to the world. If too many of them demanded gold at once, the treasury would be wiped out. Nixon's team feared that moment was near, so they struck first. No notice to allies, no coordination with trading partners, just a cold, calculated shock to the system. While gold stock remained stagnant, external dollar liabilities surged, making the dollar-to-gold promise mathematically unsustainable by 1971. And yet, the real story wasn't just the visible pressure. Beneath the surface, the foundations had been eroding. For years, gold had been playing a smaller role in America's total reserves. On paper, the reserves looked solid, but subtract gold and you saw a different story. According to the World Bank data, the U.S. was increasingly relying on other assets like foreign currencies, bonds, and international instruments such as SDRs. Gold, once the backbone of trust in the dollar, was fading in importance. This shift gave policymakers more flexibility, but it also made the system more vulnerable. Some historians view Nixon's move as a courageous pivot. Others see it as an economic betrayal. But either way, the consequences were immediate and permanent. The global economy had entered a new era, one without gold, one where money itself was redefined, and the world was just beginning to feel the tremors. To understand how things reached that point, we need to go back a few decades. By 1971, the global monetary system was already under serious strain. The structure that kept currencies tied to the dollar and the dollar tied to gold was starting to resolve. This system had been built after World War II in 1944 during the Bretton Woods Conference. Under the agreement, countries would fix their exchange rates to the US dollar, while the dollar itself would be convertible into gold at $35 per ounce. For many years, this arrangement offered stability, predictability, and control in international trade. But as the 1960s wore on, the pressure started to mount. The United States was spending heavily on the Vietnam War, sending aid across the world, and importing more than it exported. This created large trade deficits, which led to more dollars flowing out of the US and into the hands of foreign governments. Many of these governments began to convert their dollars into gold as the Bretton Woods rules allowed, but the US couldn't keep pace. The gold required to redeem all those dollars simply wasn't there. The gap between the number of dollars circulating globally and the amount of gold backing them was growing fast. Confidence in the system began to falter. It became clear that the US could not honor its commitments under the original terms forever. The risk was simple. If too many countries tried to redeem dollars for gold at once, the foundation would give way. In an attempt to defend the $35 gold price, the US and several European central banks created what was known as the London Gold Pool. This informal arrangement, active from 1961 to 1968, involved countries pooling gold and coordinating interventions to stabilize the market. The idea was to sell gold into the market when prices rose above $35 and buy it when prices dipped. For a time, it worked, but only just. Eventually, the underlying problem, too many dollars, not enough gold, became too large to ignore. In March 1968, after heavy demand and speculative pressure, the London Gold Pool collapsed. From that point forward, the world began to split into two markets: an official market, where gold still nominally traded at $35, and a free market, where the price was higher. The chart highlights how this imbalance grew over time. By 1968, the pattern is clear. More gold was leaving US control and less was left in reserve. By 1971, the system was in survival mode. This was the environment Nixon inherited. The collapse didn't happen overnight. The trap had been set years before. But here's the twist. The strain wasn't only international. Domestically, the numbers were beginning to turn against Washington. While global markets were falling apart, internal problems inside the US economy were also reaching a boiling point. Throughout the 1960s, inflation in the United States had been steadily rising. By 1971, it reached nearly 5.84%, a level that caused concern among both policymakers and the public. At the same time, unemployment hovered at 6.1%, this becoming a troubling combination that weakened confidence in the economy's overall direction. Government spending, driven by war efforts abroad and expanding domestic programs, had been persistent. As prices rose, so did frustration with the dollar's shrinking value. Another concern was the strength of the dollar itself. Despite domestic inflation, the US dollar remained overvalued against many major foreign currencies. This created an imbalance. American-made goods became expensive overseas, hurting exports. Meanwhile, imports became cheaper, leading to rising demand for foreign products. The result was widening trade deficits. Other countries continued accumulating dollars in large quantities, but they were growing uneasy. Confidence in the dollar's long-term stability was eroding. Behind all this was a deeper issue. The US was losing gold. Monetary gold reserves were falling, not just because of redemptions by foreign central banks, but also because the dollar liabilities held abroad had ballooned. As the gap widened between gold in vaults and dollars in circulation overseas, the peg to $35 per ounce looked increasingly unstable. The system relied on trust, and that trust was fading fast. As you can see, the inflation trends across the US and other G10 countries from 1948 to the late 1970s. By the early 1970s, inflation in the US began rising faster than in many peer economies. As the dotted line shows, US inflation spiked just as pressure on gold reserves intensified. This divergence made it harder to maintain fixed currency relationships and added urgency to Nixon's eventual decision. And the world didn't wait long to react. The shockwaves were immediate. With gold convertibility gone, global currencies entered a period of rapid adjustment. Some countries let their currencies appreciate against the dollar. Others defended their pegs briefly before giving in to market pressure. Fixed exchange rates, once considered stable, were suddenly up for negotiation. Confidence in the post-war system was clearly fading. Meanwhile, Nixon's 10% import surcharge, announced alongside the gold suspension, remained in place. It wasn't meant to last forever, but it did enough to shake foreign governments. After months of negotiation, the US reached a deal with other major economies in December 1971. It was called the Smithsonian Agreement. This agreement redefined the global framework once again. The official gold price was raised from $35 to $38 per ounce, acknowledging the dollar's weakening position. Exchange rate bands were also widened to plus or minus 2.25%, giving countries more room to let their currency shift. It was a temporary fix to buy time, but the deeper issues remained unresolved. Domestically, Nixon's controls and tariffs had only limited effect. Inflation did not disappear, it paused. Prices remained elevated and public anxiety persisted. The economic pressure that had built up under the Bretton Woods system was still there. Nixon had delayed the worst, but he had not prevented it. The newspaper headlines from August to December 1971 captured the mood. Markets were jittery, currencies were in flux, world leaders scrambled to find stability in a new monetary landscape. For millions, the changes felt abstract, but for governments and central banks, this was a clear signal. The old world was gone and nothing yet had taken its place. The fix didn't hold. Within 2 years, pressure was reaching a breaking point. By 1973, most major currencies had abandoned their fixed exchange rate pegs. The dollar no longer served as a reliable anchor, and the Bretton Woods system, already fragile, finally came apart. Countries stopped defending narrow bands. Instead, their currencies began to float freely in the market. This was a major shift. For nearly 3 decades, exchange rates had been stable. That now was over. The move to floating rates created uncertainty. Currency values could change daily, sometimes sharply, but the change also gave governments more control. Instead of defending a fixed rate, they could focus on managing their domestic economy. Tools like interest rates, inflation targeting, and money supply became more central to policy decisions. Monetary policy, once restricted by gold limits, was now more flexible but harder to coordinate globally. As gold lost its place, other forms of reserves rose. The chart above shows how non-gold assets such as foreign currencies and securities took up a larger share of U.S. reserves over time. According to FRED data, total reserves excluding gold expanded steadily throughout the 1970s. This marked a new approach to holding financial buffers. Gold was still present, but it no longer defined the system. They played out slowly over decades. When the US closed the gold window, the dollar became something it had never fully been before: fiat money. Its value was no longer tied to any physical asset. Instead, it now relied on government credibility, monetary policy, and international demand. For a currency that anchored the global system, this was a fundamental shift. One of the most immediate consequences was persistent inflation. Throughout the 1970s, the US and other developed nations experienced what later became known as the Great Inflation. Looser monetary policies, expansionary fiscal spending, and external shocks like oil price surges all played a part. Inflation wasn't just a short-term concern, it shaped a generation of economic decision-making. Monetary theory also changed. With no gold constraint, central banks placed greater emphasis on controlling money supply, managing inflation expectations, and using interest rates more actively. The idea of maintaining fixed exchange rates became less practical in a world of fast-moving capital and floating currencies. Flexibility became the new orthodoxy. Trade and financial diplomacy changed as well. Without fixed parities, countries could use currency adjustments to address trade imbalances. Exchange rates became part of economic strategy, not just accounting rules. Looking back, 1971 was more than just a policy shift. It ended the most coordinated global monetary framework in history and replaced it with a system based on trust, flexibility, and national interest. The change brought volatility, but it also gave countries tools to manage their own economies. Gold faded, the dollar strengthened, and central banks took the lead. The post-war system was dismantled in real time, and nothing that followed looked the same. From inflation targeting to global capital flows, many of today's realities were born in that year. What seemed temporary became permanent, and what looked disruptive became the new status quo. This was just one chapter in the story of modern finance. For more like this, subscribe and stay informed.